who very rarely appears on television. Mr. Karwa is the founder and managing director of MK Global Financial Services, a very, very well known name in the corridors of Dalal Street and amongst the first ports of call for any foreign institutional investor who wants to make money consistently on Indian equities. Mr. Karwa is a rank holder chartered accountant and over the past 30 years has worked in all facets of the corporate market, whether it's equities, whether it's fundraising, whether it's corporate advisory, or whether it's asset management. Mr. Karwa, it's a pleasure to welcome you, sir, on Market Masters, and we are very grateful that you could spare your time with us today. Tell us, how do you see the next 2 years on the Indian capital markets shaping up? What are your views, sir?
First of all, thank you very much for inviting me to your show and for a very eloquent description of my background of last 30 years. So thank you very much. See, I mean, as far as the next 2 years or maybe slightly longer time frame, inherently we are very bullish and we have continued to remain bullish even now. The point is that yes, you will have events like state elections, national elections, you will have macro global events, including interest rates possibly peaking out globally. So those you will have that will bring in the volatility maybe in the process. But the trajectory of the Indian capital market is inherently positive and primarily for two, three reasons. One is the resilience of the domestic investors' inflows, which you see in the last 2, 3 years. It has been continuously been increasing. And now we have almost like 15 to 20,000 crores of domestic inflows into the mutual fund on a monthly basis. So one is earlier we used to be totally dependent upon the FPI inflow, which had volatility of own nature. But this consistent inflow helps a lot to the capital market. Now that is as far as liquidity is concerned. But fundamentally, if you look at the economy itself, I think we are in a very sweet spot in terms of our domestic resilience and the opportunities that we will, many of our companies or economy will get from the overseas opportunities also. So fundamentals of the domestic economy are very strong. Valuations wise, we are not expensive. We are at par with our last 5, 10 year averages. So that also gives you hope. So from that perspective, if you're looking at from the next 3, 5 years perspective, we should be able to make decent returns by investing in the domestic capital and our equity markets.
Right. Mr. Karwa, you are also, as I said in my opening remarks, amongst the first people that long-term foreign institutional investors look forward to your advice when it comes to making money on our domestic bourses. Tell us what has changed in their interaction when they come and meet you. How are they perceiving India? Of course, you've highlighted our strengths, the strength of the Indian market. But when a foreigner comes to you asking where to put in money, what are the kind of questions that come across to you?
See, earlier there used to be very much focused on the large caps, and also their focus used to be on consumption story, on financials, which were the bigger themes. But of late, what we have seen is that the breadth of the market seems to be, I mean, they have seen the kind of depth and the breadth of the market improving. So many of the fund houses or global investors have now also started inquiring and wanting to invest in the broader growth story, and which has improved the breadth of. So even in the mid market segment, they are willing to invest in. So to that extent, we are seeing much more wider interest coming in from the global investors. Earlier, they used to be very much focused on the large caps and the financials. That was a very big area where they used to take an indirect exposure to the Indian markets. Now they are willing to go into the more granular opportunities which our markets offer. So that's a very big positive. Second, I think they appreciate the rule of the law, which is very much evident generally in our equity markets or in our ecosystem per se. So earlier there used to be a lot of positivity or fetishness for Chinese. I mean, the comparison always used to be there in terms of the value that Chinese economy offers or the stocks offers, etc. They did try their hand in March, and after that, we have seen what has happened. So here they have also kind of accepted the fact that Indian markets are always going to be slightly expensive for the growth that they offer, and they're willing to live with that. But the growth opportunities seem to be much more consistent. So these are the some of the and this is not only from new investors who are coming to the market, but even veterans who have been in the investing in Indian ecosystem for years. They have also kind of accepted that Indian markets are always going to be slightly expensive than normal, and there will be some volatility, but generally the trajectory is on the positive.
Right. Good afternoon to you, Mr. Karwa. Sakshi this side. I was going through your Twitter feed, and the two things that prominently you have mentioned in some of your tweets is one about cricket and the other about manufacturing theme. I'm going to be asking you on both. One, festivities are over. The World Cup happened without a victory cheer that we have. What is the one lesson that you would advise investors to take from the kind of loss that we've faced? A lot of equity analysts were talking about past performance is not an indicator of future performance. Is that also something that you have picked up? Something else that you'd like to share? And going forward from here, what is the stance that an Indian investor should take in the Indian stock markets now?
So yes, I think phenomenal performance by the Indian team over the last 10 out of the 11 matches, 10 matches, they did very well. My sense is that what is more important is the process that they went about and that consistently delivered for them. So I think that is, so even for equity markets, I would say the same thing, that your process should be robust. And if you're consistent in your process, then typically you will come out winners more than normal. So I think more times than not, you will come out winners. We can have a bad day, your process may go wrong, or maybe something, and you may invest in the wrong stock despite your wrong process. Similarly, maybe yesterday uh, we lost the match, but I wouldn't change my style or change my process just because I got it wrong once. So I think consistency is most important, and that is what my learning is as far as from cricket, if you can say, applying to equity markets. And yes, that doesn't mean that if a one loss doesn't make us that we leave the game or we I mean, we lose confidence in ourselves. Similarly, I think as far as investing is concerned, yes, you will have days when you will pick the wrong stock and you will lose money, but that doesn't mean anything. Overall, you should look at the portfolio returns. Similarly, we look at the return or rather the performances of the team over many matches rather than just focusing on one match which we must have lost.
Right. On the other thing that you talked about a lot, the manufacturing theme, the China plus one benefit that India has been talking about. Of course, we've been discussing this theme over the last 1 or 2 years or so. Going forward from here, do you still believe that manufacturing is going to be one of the themes that long-term investors looking to invest in Indian equities over 5-10 years should have in one of their core portfolio stocks?
I'm glad that you focused on this because this is one thing which is very close to my heart, and I have been focusing on it for now almost more than 2 years. Yes, I think the time has come for the manufacturing sector in India to get its rightful place in the ecosystem, and primarily driven by, I think, a lot of government initiative in terms of giving the right encouragement to domestic manufacturing, whether it is in the form of PLI schemes or in terms of various other incentives, or even supporting Make in India and Atmanirbhar. So that momentum has got created. And we can see that not only in the domestic corporates, the way they are putting money into various capexes, but also the kind of manufacturing that various global majors are wanting to set up in India to not only to cater to the Indian market, but also to set up for exports. I mean, it was so heartening to read the other day that Honda is going to manufacture a car. I think it's Elevate, which is they are going to export to Japan. Now imagine a car manufactured in India being exported to Japan. I think it's a very big positive. So these are the events which certainly convince you that in the next 10 years, domestic manufacturing will pick up big time. Yes, we also get the support from this China plus one opportunity. And yeah, so that will again create a momentum of its own. And this is across sectors. You can see manufacturing is a very wide theme, which is it covers almost, if I look at from a market cap perspective, almost 55-60% of the market. If you remove financials and IT services, which constitutes around 35%. So within that, you can obviously create a very resilient portfolio across market caps and across sector, right from say specialty chemicals to auto ancillaries, engineering companies, capital goods, defense companies. So there is a whole spectrum, pharmaceutical companies. So there's a whole spectrum of companies which form part of the manufacturing sector. What we have seen is that even because financials and IT services have done well over the years, most of the portfolio, whether you are a direct investor or whether you are an investor in mutual funds, etc., the portfolios are very much overweight on these services sectors versus that the manufacturing part of the portfolio,
Right,
which
sir.
is much more resilient, is much less. So we are very gung-ho and positive about the whole opportunity to invest in manufacturing sector, not only from the next 2-3 year perspective, but maybe the next 8-10 years. I think this sector should outperform the other segments of the equity market.
Right. Mr. Karwa, let's drill a little deeper into the manufacturing space. Over the last at least 20, 25 years, we've realized that financial services and software exports have more or less occupied our brain space in terms of investing as also in terms of how the economy functions. Now, if you were to set up a portfolio for a foreign institutional investor or a large family office in terms of tapping the manufacturing space, how much of that portfolio would be in the manufacturing sector? And within the manufacturing sectors, how would you allocate, say, money to auto ancillaries, to OEMs, to pharma space, to chemical space? How about old industrial houses which are making a comeback, like the Kirloskar Group, like the Mahindra Group? How would you allocate that fresh money?
See, I think, as you rightly said, that maybe 70-80% of the portfolio, 70% of the overall new, if you are putting new money into the market, maybe 70% of the money should be allocated to the manufacturing sector versus say 30-35% you could put into the services sector. That's our take, and primarily driven from the maybe better opportunities that you will see in the manufacturing versus the IT sector or versus the financial sector. What happens in financials is it's a very well discovered sector, and as you grow over there, you require constant doses of dilution or capital raise. So sometimes the growth of the sector may not be fully captured by the investors. And IT is again a very well discovered sector, and a lot of I mean, it is susceptible to whatever happens in the global market. As far as manufacturing sector is concerned, I think the base is very small as far as India's share of the global merchandise export, etc., is concerned, and the focus on domestic consumption itself. So many of the manufacturing opportunities would also focus on local opportunities plus the global growth opportunities. Now, coming to the segments of the market within the manufacturing where you would invest in, I think that will be sometimes it will be opportunistic also, which means that at any point of time you will have to look at the underlying valuations and how the investors have discounted the future for some of the segments. Like for example, we have seen superb, very good stock price performances of many of the defense companies in the last 18 months. So maybe we have discounted far ahead. So today I may not want to put fresh money into a defense business, or even maybe for that matters, many of the companies which are connected to the railway sector. Again, sunrise sector, a lot of opportunities, but the stock prices have done well. Versus that, say 2 years ago, specialty chemicals was a flavor of the season. stock prices did very well. But in the last 12, 18 months, we have seen that for global reasons, in terms of overstocking, etc., many of the specialty chemical companies have corrected, and maybe some of them are available at very attractive valuations. And we feel that incremental money, if I have to put in, I would first tend to put money into some of these sectors where valuations have become attractive. Of late, we have seen also pharmaceutical sector has started doing very well, which again, before that, maybe at least for the last 12, 18 months before that, did not exactly deliver. So again, that has gone through a correction. So we would be more investing in the pharmaceutical sector. So obviously, within manufacturing sector, you will tend to invest based on your entry level. Your theme remains that there is an opportunity from a domestic and a global perspective, but please keep an eye on valuations, because as markets are never in balance. They will either be too pessimistic on overall or any sector, or they will be very over optimistic. And we need to make the benefit, I mean, we need to take advantage of that, which is what, when you are on a top down basis, you know what you need to do, but on a micro basis, you need to figure out where the deep value is.
Absolutely. And that's the fine balance that all equity strategists, as well as asset allocators, walk on a very regular basis: what to buy when and what to sell when. Mr. Karwa, let's touch upon the latest action that the Reserve Bank of India has done on assigning heavier weights on unsecured loans, which have grown dramatically over the last 2, 3 years, simply because of fintech lending, and of course other purposes, because the aspiration in the Indian economy is growing dramatically. One, how do you read this as a step in maintaining the overall sanity of the country's balance sheet? And two, you've already mentioned that the financial services space is already very well discovered within the investment fraternity. Do you see these dips that have come in stock prices an opportunity to add quality into your portfolio within the financial services space?
Yeah, as far as our central bank is concerned, I think they have always been very proactive in terms of wherever they find over exuberance or risks in the system. So for them, it is important to highlight and bring in regulatory measures to ensure that we don't go overboard in any segment of the lending market, and rightly so. And this is what the RBI has signaled. I think they mentioned about it also in the last policy, and then now they have brought in higher weightages, risk weightages, etc., to rein in, or rather at least increase the costs for the borrower in terms of the unsecured lending. My sense is that yes, there will be some increase in cost to the borrower, but if there is a demand, and if the lenders have the adequate capital adequacy, the lending will still happen in that segment of the market. Only thing is that at least RBI is ensuring the sanctity of the system by increasing the provisions required or the capital required as far as the NBFCs or the banks are concerned. So that's the way. And yes, in a way, it's also a slight nudge that, okay, unsecured loans, personal loans are a easy or rather a profitable way of growth for the banking system, but they need to focus more on the SME, on the mortgages and that part of the segment also. So maybe a slight nudge towards that segment of the credit system. Having said that, as far as financials are concerned, if you look at what has happened in the last 12 to 18 months, is that the well discovered companies where investors are all invested and over invested, they, despite the best of growth numbers, best of credit cost, etc., they have not delivered as far as the capital market is concerned. It is the tier 2, tier 3 banks, or it is the tier 2, tier 3 NBFCs focused on maybe MFIs, maybe SME financing, etc. So they have enjoyed the tailwinds, and their stock prices have delivered far superior returns. So my sense is that investors need to be cognizant of the fact that if there are tailwinds in any segment, and the top companies would possibly have already been discovered and invested in, it is the top tier 2, tier 3 companies where there is an element of under ownership, there is an element of undervaluation, where if you invest, you will make money. And this is what has happened in the financial services sector or financial lending, NBFCs or banks in the last 12 to 18 months. I think I forgot the second part of your question. Hello?
Right.
Can you?
Mr. Karwa,
Yeah.
actually, I also wanted to understand in the same breath when we are talking about the banks and NBFCs, are the smaller and the younger entrants going to get more impacted? You know, stocks like SBI cards, Paytm, PB Fintech, are they more vulnerable to such changes?
Yes, all the lending platforms, they will be more susceptible because they have only the well-rounded banks or the well-rounded NBFCs have many levers of growth. But many of these platforms where unsecured lending is the major part of their growth profile or product profile, they will tend to get more impacted than normal. So what you say, I agree with you, and maybe markets will also maybe it will not be visible in the immediate quarter, but in a few quarters it will become more and more visible that the growth is impacted or the profitability is impacted more than normal.
Okay. Right, Mr. Karwa, the other space that I wanted to discuss with you is the IT space. You know, that's the other big underperformer of the previous Samvat, especially when we talk about the large cap IT names as well. Going forward, are you looking at these big IT names more favorably now? Have things turned for the better? And for anyone holding these IT names for a long-term view or looking for a fresh entry point, is it a good time vis-a-vis the kind of outperformance that we've seen in the mid-cap IT names? How would you advise a fresh investor to really look at these two baskets, which have really performed in complete divergent ways?
See, I think if you look at the commentary from all the large IT companies in the last 3-4 quarters, as we possibly sense that there is a slowdown coming in, and every quarter, I think the majors have all, I mean, they have not improved their guidance in any form, or rather, they are also not aware of how business is going to flow in the coming year. So they are also basis communications or interactions with their clients, etc. What they communicate, and then every quarter they keep on revising it down. So my judgment is that uh, there is a consolidation which is happening business wise. So growth is a struggle as far as these companies are concerned. Margins have gone up, profitability is strong. So these are cash generating machines. So there is an X valuation at which these companies will form a bottom. We are closer to stabilization as far as the valuations of these companies are concerned. Growth is something which I think it will take some time before we see growth coming in. So for institutional investors, because IT forms a decent part of your indices, etc., so they will perforce hold it as part of their portfolio. But for direct investors or individual investors, I think generally if you invest in growth companies, you probably make better returns, and they can time their entry into the large cap ITs company once they see some green shoots of recovery in the US market and accordingly in the business profiles of these companies. Then yes, mid-market companies have done well, and if you find the right niche opportunities, then IT mid-market IT companies will continue to deliver superior growth and superior returns. But having said that, I think many of the mid-market companies also valuations wise, they are at par or even more expensive than the large IT companies. So one has to be very careful in terms of which segments of the IT I mean, these companies, which segments of business are we investing when we are investing in the mid-market IT companies.
Absolutely. And Mr. Karwa, you hit the nail on the head. When you look at mid-cap IT valuations, there are absurd PEs of, 65, 80, 90, trading, of course, depending upon how quarterly results have panned out. But yes, Even as an overall mid cap IT theme, it's at least 2.5, 3x more expensive than large cap IT. You've made us known your preferences in terms of going after under owned and beaten down sectors such as specialty chemicals and pharma to some extent. How are you addressing this whole PLI scheme, which has been set up by the government over the last 2 or 3 years? And we've seen some fantastic results coming in the form of how Apple has come up with its own ecosystem, how companies like Dixon and Amber are doing. This is a whole new universe coming up in front of us. Would there be any bets that you are taking in this PLI led change in the manufacturing sector?
So without naming specific companies, I think there are so many segments of the whole PLI schemes which is beneficial for manufacturing per se. So we have seen opportunities in the contract manufacturing or engineering contract manufacturing companies, or there we have seen some very positive benefits coming in. So we have invested in those kind of companies. But having said that, I think somewhere we also need to be very careful about how these PLI schemes are being executed by the manufacturing companies also. And so we have invested in a few such companies, but primarily what one has to look at is not just because there is a PLI scheme that the company has won, etc. I think it's fundamentally the business opportunity per se that you need to be very careful about, and the opportunity that comes up. And then accordingly, if there is a some of these companies have won PLI benefits, then yes, we should look to invest in those kind of companies also. But primarily, I think the PLI benefits have been there for so many sectors. We'll have to go sector wise and on a top down basis, and then figure out which is the sector or which is the company that you would like to invest in. It should not be the other way around, that you start from because there is a PLI scheme which has benefited, and then you start looking to invest. Because what happens after 3-4 years once the PLI benefit is over? Then what happens to those companies? I think that's a key question that one needs to answer.
That's a fair point that you make. Mr. Karwa, the other thing that has happened over the last 18 to 24 months is this wonderful discovery of old horses that we would flog incessantly, the PSU basket. Nobody was keen to buy government shares. And today we see a very, very sharp run up in metal stocks in smaller public sector banks, which were lying, doing nothing over the last 10, 12, 15 years. How do you see this change in sentiment that has happened post the arrival of the Modi government at the center? And is this change something which is going to be a secular trend, or once you get your decent value, you get out of these stocks?
My sense is that selling is always a function of valuations at any particular point of time and what kind of return that you expect over the next 2 years from any. Now, whether it's a PSU or whether it's a private sector, it doesn't matter. Valuations have to be the key and the growth opportunity that you expect in the any company or any sector for the next few years. But having said that, I think, as you rightly said, that I think in PSU, what happened is there was utter disbelief maybe 3-4 years ago. So valuations were very, very attractive. And then many of the sectors had some tailwinds also playing out. So, for example, in defense companies, what you saw, many of the defense company stocks were doing phenomenally well, or some of the NBFCs which are focused on energy, they delivering. Valuations were also attractive, and investors recognized the opportunity in those kind of companies. So I think that plays out more into a theme that the breadth of the market improved tremendously in the last 18 to 24 months, which is again reflected in the earnings. The Nifty has grown, say, around 8-10% in the last 1 year, versus that your small mid-cap indices have grown by some 35 to 40%. And even if you look at the earning growth of the BSE 500 is far, far superior than the earnings growth of Nifty in the last 1 year. So I think what has happened is that the investor depth has increased a lot. So you have a lot of direct investing, you have a lot of AIS, PMSs, those kind of investors who are willing to take bet on these companies which are not part of the mainstream. Earlier, it used to be only the institutional investors who were dominant in the ecosystem, and possibly PSU also, for some reason or the other, were not exactly their preferred investment bets. But in the last 12 to 18 months, I think A, performances of of many of these PSU companies, and B, the valuations, and some of the government policies which makes us believe that in the coming years, many of these companies will deliver superior returns. All have played into, and we have seen superior returns. So again, it again boils down to what I said in the beginning: is wherever there is under ownership, wherever there is disbelief, and if there are some opportunities, probably you will see far superior returns than when there is a consensus view. So today, if you ask me, I will struggle to find too many ideas in the PSU basket where already most of the value discovery has happened.
Okay,
As far as
but
bank PSUs are concerned, yes, as I said, there was under ownership, and the system has been cleaned up, and they were also delivering good growth. So we have seen the tier two, tier three PSU banks deliver superior returns. I think there's still scope for them to still give you good returns versus the main stream private banks.
got that. Staying with the PSU theme, sir, I wanted to ask you your view on the entire power space, which has already, performed quite a lot. I mean, rarely have we seen an NTPC or a Coal India give the kind of returns that they've done in the previous few months as well. Even power finances, you must have noticed PFC, REC, they've actually doubled their book value in the last 6 to 8 months odd already. There is also new buzz in this space. IREDA, IPO is lined up now. How are you looking at this entire energy basket, and does this interest you for a long-term perspective, and how would you be approaching it?
Yeah, I think within that, I would say that the whole opportunity as far as renewable energy is concerned, that is a sector which has a lot of tailwinds and for the next 5-10 years. So that sector is expected to attract a lot of investment. So whether it be the financiers or whether it be the EPC companies which are connected to these sectors, they will definitely, or some of the companies which do manufacturing associated with these sectors. So they will deliver superior returns, and investors have recognized the opportunity. But I still believe that there is an opportunity for many of the players in the ecosystem to deliver very good returns. As far as the power generators are concerned, I think so many of these companies, which are erstwhile thermal majors, but now are adding a decent portfolio of wind and solar. There, I think the cost of capital is something which is, or cost of debt is a very important factor to help you determine the valuations. And whoever has got a superior capability of cost of borrowing, I think they will possibly be winners in that. And it's not only the PSUs, but many of the private sector players also are becoming big in that whole ecosystem. So that's a very big part of the market, and it's one of our favorite themes within the manufacturing space to invest in some of these companies which are part of the renewable ecosystem, renewable energy ecosystem.
Okay, understood. I'll also ask you on the entire IPO space, which is red hot right now. I mean, 6 IPOs are lined up for this week as well. From Tata Technologies, the first from a Tata Group stable, to IREDA, which I'm talking about, which is already the first government-backed, company after LIC that's coming in right here. We have Flair Writing, we have Fed Bank Financial Services. A lot of IPOs from various sectors are coming through. How are you looking at this entire IPO basket? Any particular names that you're also looking at favorably, and how would you advise investors to really approach when suddenly so many IPOs come through? How should one really take that decision as to which IPO suits which portfolio?
Yeah, I think we have seen very good, a buoyant capital market or IPO market for the last 6 to 8 months. And the best part is that most of the IPOs which have come are at valuations which are reasonable. They are not obscenely overpriced the way it happened around 18, 24 months ago, where you had many of the platform companies at obscene valuation. I think this time around, the whether it's the offer for sale from the private equity companies or the fresh money being raised by many of these companies, their valuations are not out of sync with what the valuations of currently listed companies are concerned. So to that extent, we have seen that post-listing there has been good gains. Most of the companies have sustained their valuations, and to that extent, it's a very buoyant market, and rightly so. So that's one part of it, and this is very good that so many IPOs and new companies. Some of them companies are part of existing sectors where there are many companies, but some of them are opening up to new sectors where investors can invest in. So it just increases the breadth of the market, which is just representative of the overall growth in the economy as far as the various sectors which are opening up. Having said that, my sense is that what investors need to be careful is that just to comparison of say existing comparisons from listed companies which are already there, and then take a call about whether to invest in some of these companies where listed comparisons are available. I think that is the only caveat one needs to be careful about. Don't get taken in by the euphoria. But I would say generally merchant bankers and issuers are very, very careful about the valuation. This time there is not too much of overvaluation, at least that's what we observe. I cannot name any companies in terms of which fund investors should invest in because that's not our mandate.
Mr. Karwa, let's touch upon a sector which has taken up the market by a storm, and of course, old equity hands like you, which is the digitization theme in India. It's work for the benefit of the entire economy, and you have global sized companies like Zomato, which have set up very strong, how should I say, majority businesses in India without much effort over the last 2 or 3 years. One, do you still find this space attractive as a long term bet where the Indian economy is headed? And two, uh, should this sector be a choice of yours? What is the overall percentage in the equity portfolio you will have for these internet companies?
No, very nice question and very interesting. I think, see, what is happening is that wherever these companies have consolidated the market, which means that the whole market opportunity may be shared between two, three players. I think there the growth these companies will show will be phenomenal. Like for the food delivery companies that you were mentioning, the kind of growth that they will show will be far, far superior than what the underlying food companies or the QSR companies from where they most of the time deliver. So the opportunity for investors is to invest. They should definitely look to invest in such businesses where consolidation has already happened and where you can see growth of say 25, 30, 35% over the coming years. And many of these companies, when they went public, probably they did not have a clear path to profitability. But now, apart from growth, they are very much focused on how to become profitable. And we can see in the next few years, many of these companies would be highly profitable also. And this is a very high operating leverage business. So the profitability of many of these companies will be far, far superior. So yes, it has to be a part of your portfolio. Some of these companies should be a part of your portfolio. Idea is that some of them, I mean, yes, there can be some disruptions from new technologies or new private equity funded businesses which try to. So yeah, you should invest, and if you find the growth as per your expectation, then maybe add more because these are companies which will have extremely superior growth versus the some of the old established businesses which these businesses are catering to. I don't know whether I've made myself clear.
No, no, it's abundantly clear, Mr. Karwa. And what you see in the internet space at the moment is similar to what was in 1996 to at least 2002. in companies such as Infosys, in companies such as Wipro, in companies such as NIIT. It's the same flavor that's coming back. Extremely obscene growth levels, very high profitability, and very high demand. Mr. Karma, the
Absolutely.
other thing that is happening in the Indian market is that we are now headed into election mode. You can just see how volatility has been sapped out of the Nifty and the Bank Nifty. They're just moving sideways post the festive demand. First, how do you see the elections on the state level? And then we have the big one coming in February to May 2024. What are your thoughts on that space?
First of all, let me make a disclosure that yes, I do try to keep a track of political developments, but that's not my core area of strength. So probably what I'm saying is what I've just read generally. My sense is that what we have seen is that assembly elections and national elections are two different things. And there have been setbacks for the ruling party in the assembly elections for some time now. But that has not impacted the overall direction of the growth of the economy or the decision making of the central government. So even after these assembly elections, where you expect some change in Rajasthan and some maybe kind of iffy decision as far as MP is concerned. So my sense is that whichever way the rivers flow, markets are not going to be bothered too much about the election results. They will continue to depend upon business per se, or rather reflect the fundamentals of the economy and the valuations and etc. Having said that, yes, national elections. Uh, what happens over there in the last 145 days before the elections, you never know how things behave. Currently, the assumption is that yes, the existing setup will continue, maybe with maybe some lower majority than what it was earlier, and that's what the market is kind of pricing in. And if it behaves that way, I mean, the election outcome is accordingly, then there is no problem, because then you can see a continuity of policies, etc. But God forbid if there is any reversals, then there will be a knee-jerk negative reaction. But having said that, I think whatever growth policies have been set into place, whatever benefits of the infrastructure created, the economy's momentum, it beyond the point it cannot be reversed just because there is uh, some reversal as far as electoral fortunes are concerned. So yes, there can be some hiccup if there are some reversals, but currently I don't think so we should be worried about that. I think every day there are some geopolitical situation, something happening in some part of the world. I don't know how investors can continue to change their portfolios based on so many macros. I think that is the
Absolutely.
net part of it.
As long as you buy quality, as long as you buy it below its intrinsic worth, I think we all should be very happy. Our last question to you, Mr. Karwa, is that over the last three odd decades, people like you and me have been waiting for this wonderful Goldilocks moment for India as well as the broader economy, and it seems to be here. We are an island of safety and oasis of strength, as also phenomenal growth that is coming in as far as the broader economy is concerned. Is there a pain point? Is there anything that keeps you awake at night which might spoil this party?
No, I think not specifically anything, but the only thing which is that somehow or the other we figure out how to dig our own grave. That is what has been the situation for the country many times, that we goof up somewhere or the other. How we goof up, I don't know. So there has been opportunities like that earlier also, and then we somewhere faltered. So yes, theoretically we should do very well in the next 10, 15 years. But I just keep on looking at that, what is that blind spot which I am missing? And currently, as of now, I don't think so. I have been able to figure out what can go wrong this time around in the next 10 years. What can go wrong for us? So, yes, we have to be vigilant. I would say from an equity market perspective, I would put it the other way around. is that what I need to be just worried about is that the euphoria shouldn't be beyond my comprehension and the valuations shouldn't go berserk. I think I will just keep a track of that and that will help me survive. So if I believe that valuations have gone berserk or we have discounted far too in advance, I think time to take money off the table despite all the positives that is visible in the ecosystem.
Right, Mr. Karwa, with that, we'll have to bring this wonderful discussion to a close. Thank you so much for your wonderful time.
Thank you.
And we will now make you a regular on our other shows. The other point that I wanted to mention, Sakshi, raising the cricket analogy with you is because I'm in Ahmedabad and I watched that match last night at the stadium, and she's taking one revenge on me for not being here.
Thank you very much, and thank you. It was great to have this session with you, and look forward to many more interactions. Thank you.